Okay, let's see. Are we going to be able to hear? Shasi, are you able to hear us?
Can you hear us?
Hello?
Yeah, we can hear you.
Okay, let's see. Are we going to be able to hear? Shasi, are you able to hear us?
Can you hear us?
Hello?
Yes.
Yeah, we can hear you.
Okay.
We can hear you.
You can hear me now?
Yeah.
Okay.
Can you hear us?
Yes, I can now. I don't know what happened.
Hopefully it doesn't happen again.
I know, right? Technology.
Oh.
Uh-oh.
Still good.
Okay.
And Jorge, we're up to 23 participants this evening.
Okay, do you want me to wait another minute or so?
Yeah, we can wait another minute. Jorge, we're still hanging out at 23, so I think we are good to go.
Okay, and Jim is here, right?
Yes.
All
We
right.
have Dr. Butler, Professor Nolen,
Our
we have
esteemed.
Ms. Wilson.
yeah.
We are ready to rock.
All right. Well, welcome to the session 4 of small business financing of the readiness training program for historically underutilized businesses, affectionately known as hubs. We want to welcome also our class participants and a special welcome to our presenters whom Dr. Jarrett will introduce in a little bit. We want to mention that we are live streaming, and I want to give a shout out to our live streaming audience. And of course, we're very grateful for the sponsorship that Travis County has given the RTP for hubs. As you see, we've got a good contingent of businesses that are participating in our training program. They've been very punctual and have participated in all the activities that we've offered to date. And I want to remind our audience that this is funnel 1 of a 2-funnel training process that we have. Funnel 1 is basically letting our class participants become aware or renew their awareness of governmental contracting, and then transition into capacity building. And so then tonight's session, small business financing, is that we're transitioning into now capacity building for hubs. And want to also mention that the esteemed presenters that we have today come from the UT family, and that gives us an end-to-end training process. I want to recognize also our program staff, of course, our 2 PIs, Dr. John Butler and Dr. James Jarrett, your esteemed moderator here, Jorge Anchondo, and of course, Emily Spandenkow, who is both our project manager and production manager. And also want to mention Evan, who is our student intern. And at this point, I want to recognize our PI, our co-PI, Dr. John Butler. Dr. Butler, can you give us a few words tonight?
I can. I'm delighted to hear Professor Jim Nolen's words of wisdom. He is the #1 person in Austin, Texas, Central Texas, and perhaps America on finance and new venture. He has worked considerably with the city, state, the region, country, and it's just such a opportunity to have our participants listen to Professor Jim Nolen, a dear friend, and certainly the most knowledgeable person I know in finance. Not only does he know about finance, he knows about everything, and he knows something on everybody, so he knows something about finance. So Jim, I want to just welcome you and thank you so much for participating.
Thank you, Johnny.
And I also, of course, want to acknowledge Shasi Wilson, who will be joining him, Professor Nolen, during the presentation.
Hello, thank you for having me.
Okay. And of course, just to review briefly what we did last time, we had a tremendous session. We had the leaders basically in public contracting in the country. We had the state of Texas statewide hub program manager here. We had the TxDOT here. We had the University of Texas Office of Hub Programs, the UT Austin Hub Office as well, and of course the Texas DIR. And last week was a busy week, and we had what we called our business advisory workshop. And I want to give a special thanks to our participating companies that are listed, and also to the business advisors that we had. I had the pleasure of moderating Group A, and of course, Dr. Butler served as a business advisor. I believe Dr. Butler, he's gone off, but I believe, was it Group B? Was it B where Dr. Butler was in?
Yes, I'm here. I just, yeah, we had a great time and we had a great group. Yes. Mm-hmm.
Yeah. Anything else you want to say, Dr. Butler, about your group?
Well, what we did was we looked at firms and where they were in the process. So we did a strategy session, and Jim, we did a lot of stuff on funding. I think that is and we talked about the relationship between funding and strategy, and just basic kind of concepts, everything from valuations to convertible notes and those kind of things. It was good. We had a good time.
Thank you for participating, Dr. Butler. I know we really loaded up on you last week. And I wanted to maybe put some of our participating companies on the spot. If there are some who want to, that participated, I know, I was really excited about the dialogue that we had between our companies and our business advisors. Would there be somebody from Group A that would want to say something about their experience?
Yeah, Jorge, it's Andy Smetana. I'll go on video real fast. We had a great learning. We went through value propositions from each company. I had actually been in business 20 years and never done one, so it was a learning experience for myself. And we got great feedback from our business mentors. So I found that was exciting to get that feedback, and it was also fun to hear from other companies, incorporate the learnings from the other companies into our own value proposition. So I got a lot of value from the discussion.
Thank you, Andy, for that. And of course, one of the things that we were trying to do here as well was encourage peer-to-peer networking. And finally, is there anybody from Group B that would want to say something, or C? Don't be shy now. All right. Well, if you can't, I can't see you, so I couldn't call on you. But we'll go on to the next slide here. And of course, before we get to our main presenters, I want to introduce Dr. James E Jarrett. You know, I know him as Jim, and a lot of you do as well. He's the project co-principal investigator. Jim is also a senior research associate at the Bureau of Business Research and has worked, of course, the majority of his professional career with the IC Square Institute and with the BBR. He's conducted research in many areas and throughout Texas and the United States. I also want to acknowledge just the yeoman's work that he's done in this project, and it's really put us on an exemplary track. Saying that, you know, I turn the screen over to Dr. Jim Jarrett.
Thank you, Jorge. Let me provide some additional details about our two main speakers. Jim Nolen is a distinguished senior lecturer in the Department of Finance at McCombs. He received his BBA and his MBA from UT Austin, and he's taught both undergraduate and graduate classes at UT for the past 35 years. He has also taught in the Mexico City and Dallas executive MBA programs and has received numerous teaching awards. He has extensive executive education experience, having worked with corporate clients such as Dell, Texas Instruments, Essilor, PetSmart, St. Jude Medical, USAA, Shell Oil, HB Zachary, Applied Materials, Siemens Energy, and Baylor Scott and White. He serves on the board of directors of an independent bank, a pre-employment testing firm, a software company, and a general contractor. Shasi Wilson is Senior Vice President at the American Bank of Commerce on West Breaker Lane. She's worked in commercial lending for nearly 19 years, including managing the SBA lending department at ABC for the past 10 years. In between her banking stints, she owned her own financial consulting business for 21 years, working with small business owners on business plans, projections, and SBA package preparation, as well as arranging financing. She specializes in working closely with small business owners to help them realistically assess their cash flow capabilities and needs, and to align those with the proper bank financing programs. We are going to wait and hold the Q&A until both Jim and Shasi have spoken. And the participants, if you could put your names in the chat, so when we open it up, we'll be able to call on you that way in that sequence. Jim, Shasi, welcome. It's all yours.
Thank you, Jim.
Thank you.
All right, so I'm going to share my screen, and the slide deck you should have access to as well. But we're going to talk about some of the capital sources available to small business, but we're going to focus really on, debt capital, bank capital, and some non-bank asset-based lenders. Equity capital, as Professor Butler talked about, there are a lot of venture capital firms. Just a little more on my background. In full disclosure, I actually am on the board of directors of American Bank of Commerce as well, where Shasi is our SBA lender. And I've been on that board for 25 years. I also run our Venture Fellows program at McCombs, and I have 18 second-year MBA students that are interning at all the local venture capital and private equity firms. And then I had a consulting practice for many years where started out doing workouts and turnarounds, then it went into kind of raising capital for privately held companies of both debt and equity. And over the years, some of my clients have been with me for 30, 35 years. Now it's doing a lot of business valuation, merger and acquisition advisory services, and them saying, my kids don't want to take this thing over. What do I do with this business? So helping them kind of monetize and sell the business. So, wearing all those hats, I can, kind of sometimes wear the academic hat, but a lot of this is going to come from consulting and being on the bank and talking about what sources of capital are available to small business. And I will tell you that, most businesses follow a pattern of how they raise capital. And when they first start, it's usually their own funds, their own capital. And then what we call the 3 F's, which are friends, family, and fools, that come next. And so you'll get some people maybe that are really investing in your company because of you, not so much that the opportunity is that great, but they're really backing you. And then the next step is to establish lines of with your vendors and things like that, that is unsecured credit. And then usually people will go to a bank to raise capital, primarily because there are a lot of them and they're on the corner of every intersection, it seems like. But most businesses know that they're in the business of lending out depositors money, so they'll go and talk to a bank. The other reason is that debt capital right now is probably the cheapest source of capital that a business can obtain. Prime rate of interest right now is 3.25%. Most banks, if you're not their most creditworthy customer, may charge 1 or 2 over that number. So you're looking at 4.25%, 5.25% maybe interest rates. If you were in Dr. Butler's Group A last week and things, if you talked about convertible debt and equity and other things like that, if you've ever gone and tried to raise equity capital from a venture capitalist, most of them are looking to get somewhere between 5 and 10 times their money back within 5 to 7 years. And if you work that number out, it's about 50 to 65% annual rate of return that they're looking for. So as a result, this, they take anywhere from 10% to 40% of your company. If it turns out that you turn out to be the next Google or Facebook or something like that, then those people make tons of money. They can return, 10, 100 times their money back investing in those companies like that. But they have to get those kind of returns because they'll lose probably 6 out of every 10 investments. And so the home runs have to offset all the investments they make that didn't turn out so well. So most companies usually go debt capital next because it's cheap and things. If the banks tell them no, they may move into more expensive kind of debt capital, and that can be non-banks and asset-based lenders and things like factoring and commercial finance companies. We'll talk a little bit about that. And now with so many fintech companies showing up, there are a ton of lenders nationally that are online that you can apply all the way from personal loans to small business loans now just using the internet. So these are the different sources. Usually we break capital into 2 sides. If you looked at your balance sheet, you got the left side, which are the assets of the company, and that's usually your cash, accounts receivable, inventory, property, plant, and equipment. So the assets of the company. And then of course, on the right side is your sources of capital, and the debt capital represents, usually secured loans, and secured loans means you're using the assets of the company to collateralize the loans that you're borrowing from the bank. And of course, they have claims on those assets. And then finally, after debt capital comes, whatever's left over are the owners of the business, the shareholders or the partners or the owner of the business. So basically debt capital, we've got banks, and these are usually secured debt that includes lines of credit, and a line of credit usually is a short-term note, usually 1 or 2 years, usually secured by accounts receivable or inventory, and it's for short-term working capital needs of the firm. Then you've got term loans, which are 3 to 7 years, maybe 10 years maturities that are financing equipment and computers and autos and things like that. So those are term loans. And then you've got longer term loans, mortgages and things, especially owner occupied if you own your own building. But longer term mortgages, they may have 20 or 25-year amortizations, even though the bank may balloon those payments and have them mature in 10 years or something like that. The amortization period is usually longer, somewhere in the 20-25 year. Then we've got a group of micro lenders, and there's some locals like Business Invest and Growth, BIG, People Fund and things. These are community organizations and things that make micro loans and development loans, smaller loans that are harder for banks to lend. And then I listed a couple of things here that are micro lenders that are online. One is called Lendio. Okay, there's another one called Fundera down here. So both of those are online. They're not local. You don't go talk to someone here in Austin. It's basically done all online. You got Just Community here in town as well. And then finally, Shasi's really going to focus on these government program SBA loans. And there are a lot of different SBA loans, all the way from the 7A program where they are guaranteeing your loan to the bank, to 504 loans where debentures are issued for longer term assets. And then also she's going to kind of focus in, since we have some contractors in here, talking about some of the lines of credit and working capital loans that SBA can make to small businesses. Then we've got non-bank and asset-based lenders. And so there are fintech companies like Build. So if you're in construction, one of the things we're going to talk about is that you go out and you get on the hub list, you get a contract from Travis County or the city of Austin or state of Texas, and you've got this contract, and it's kind of the chicken and the egg, is that you need money to start the contract, but most of the bank, a purchase order or a contract is not an asset. I mean, it helps verify your projections and things that show that you've got work. And so a backlog, a contract, a purchase order, those are all great. But until you've done work and actually have earned some of the contract in the form of an account receivable, the bank can't get a UCC filing. They can't get a security interest in a contract or a purchase order. So most of the time, banks have a hard time financing those types of contracts. So there are some that are online, Build and Funding Circle, that do some purchase order financing, contract financing, and things as well. The bank, if they're going to do that type of lending, usually are going to turn towards the SBA or other type of guarantee programs like that. There are private debt out there. There's a lot of money, a lot of liquidity right now looking to earn a yield. So people are chasing yield and risk. And so there are hard money lenders out there. So there's a whole lot of, we see people, home builder building a house, and they have gotten money from a hard money lender at a pretty high interest rate and 50% of the profits, something like that. There's factoring companies. So if you can't borrow for some reason, the bank won't lend you money on your receivables, you can go to a finance company and sell your accounts receivable. It's pretty expensive financing. We'll talk more about that later, but you've got here in town, Far West Capital is a firm here that does factoring. And then you've got online companies like Fundera. And then finally, you've got leasing and commercial finance companies like Lending Tree and Cabbage, which are pretty big, and they do both company loans as well as personal loans. usually at fairly high interest rates and small amounts of money. When we get to equity capital, like I said, there are a lot of angel investors. In fact, we have a Central Texas Angels Network as well as Houston Angel Network, which are two of the most active angel networks in the country. C10 has probably 120 angels in their group. Probably 10 to 20 are really active and everybody else kind of follows their leads, but they have quarterly pitches, and then these individual investors write checks that they get interested in some of those companies. There's also strategic partners out there, people in your industry and things that have venture. A lot of companies now have venture capital groups, and they come in and partner with small businesses. Then you got the venture capital community. Used to be probably 5 to 7 venture capital firms in town. Now they're coming in from everywhere, from California, from Chicago, from various parts of the country. And we probably have 35 to 40 venture capital firms here in town. And then finally, private equity, which are really growth capital and leverage buyouts. And so companies that are selling and they're going to sell 75, 80% of their company might approach a private equity group. And there's probably another 20 or 30 private equity groups here. For the most part, other than friends and family and maybe some angels, the rest of these usually are not very appropriate for most small businesses. Most of the time, these guys are looking for extremely high growth rates. For example, private equity might not talk to you unless you had sales of 25 million and EBITDA of $5 million. And EBITDA, what I mean is earnings before interest, depreciation, amortization, and taxes. So if you can't show, 5 million in profitability and probably 25 million in sales, then you're too small for them. Venture capitalists are looking for what they call a rule of 40, meaning that your profit margin and your growth rate equals 40%. There's not very many companies that are able to do that, can show 10 or 15% profit margin and 25% growth rates year over year. So we're not going to spend as much time on this equity capital unless we get questions. So we're going to focus on really this debt and non-bank asset-based lenders. So the types of debt instruments we see these firms issue, there's senior debt, which is secured lending. And again, it can be short-term, intermediate, or long-term. You can see subordinated debt, as Johnny said, you talked some of that. We're seeing most of the time, because valuations in venture groups for seed capital, the valuation's really uncertain. You're seeing the financing come in with the use of debt, subordinated debt. And usually it's convertible debt that's convertible either into the next round of financing of preferred stock or common stock. And if they do take common stock, then there's usually warrants or options attached to where on top of interest rates, they get right now maybe 8 to 12% interest rate, but they may take 5% equity in your company as well. And then there are some revenue-based lending groups like Austin Innovation. Now they have minimums to 2 million in revenue or so, but instead of them lending, they're just going to take a percentage off the top. And for you to have that, you have to have pretty good margins to be able to pay them that right off the top. It's not a share of profits, it's a share of your revenue. And then there are people that really are focused on things like if you've got e-commerce, they will lend against since they can see your sales through whatever platform you use to clear, Shopify or BigCommerce or something, they can get a track record of your sales, and so they can lend against that. And then the last thing is that you can also go and try and find someone that's got a healthy balance sheet that is a guarantor. And if you don't have a rich uncle or other wealthy people that'll co-sign your note for you, then we'll talk about the SBA being that guarantor to get the bank over something that maybe you have a shortfall or deficiency in your loan application. So basically, a lot of banks and other lenders do have minimums and maximums. So you ought to do your research. You ought to talk to each other small businesses. Who's your bank? Are you happy with them? Did they come out and visit? Do they understand your business? Questions like that, like you would check out any other customer things, you ought to check out banks. And for many small businesses, smaller community banks may be a better option than large banks. Large banks, a lot of times you come in and you're a small business and they'll put you with someone that usually does car loans or boat loans, and they really aren't business bankers. And you really would like to kind of deal with someone where your business is meaningful to them. You also, if you've got a really small loan, it costs a bank as much to book $1,000 loan as it does $1 million loan. The credit underwriting, other things like that can be just as costly to book something on the book. So, there are certain lenders that may say we really, don't want to lend anything less than a certain amount. If that's the case, then there are choices for microloan requests, which are usually under $50,000. Okay, and then finally, within a bank, there are consumer bankers, that do auto and personal loans, mortgage bankers that do real estate and mortgage loans, business bankers, which usually are the small business loans, and then commercial bankers, which are large business loans. Every bank is different. Some people will say small business means under 5 million in revenue. Others bigger bank may say it's anything under 10 million. So it varies by bank, but you really, for most of you, want to deal with these business bankers because that's the types of customers that they're used to dealing with. So I'm going to take you through these 6 C's of credit. So you see they all start with a C, but basically most banks, this is how they underwrite loans. And so the 6 C's are the cash flow, repayment of the loan. Can the borrower repay? And they look for 3 sources of cash flow: a primary source of repayment, which is usually the cash flow of the business. Okay, and this is what I mean by chicken and the egg. I've been on this bank board for 25 years. No borrower ever comes in and says, my projections show that I can't pay you. All borrowers show going forward that they can repay a loan, because Toner doesn't have a conscience. It'll put whatever you tell it to. So if you tell it to show you can make debt repayment, then a printer will put whatever you tell it to. Okay, so most banks are going to look backwards and say, can this business, cover this debt service that they are requesting? So you can see the problem and say, well, no, I can't, but I just got this large contract. So once we start working on this contract, my cash flow will get better and then I can repay the loan. Well, again, that means that I'm betting on something that hasn't happened yet. And that's a very tough sell to a bank unless you have a very long track record and relationship with that bank. But banks are relationship lenders. So the best thing you can do, okay, is forge a relationship, even when you don't need the money yet. Let them know what's going on at your business. Okay, let them know that you're on top so that they see that you have a really good understanding of your business and things, and they can get to know the business and you even before you request a loan. Then they look at a secondary source of repayment, and so for most small businesses, banks require personal guarantees of anyone that owns more than 20% ownership. So as part of that personal guarantee, they can look at the global cash flow of the guarantors. So outside of the business, if for some reason the business stubbed its toe and couldn't pay the loan, what do you have personally that might be able to pay this loan? So do you have investments? Do you have rental property? Do you have something, a spouse that works or something that could help support and repay this loan? And then the third source of repayment usually is liquidation of the collateral. So I know most small businesses think they over collateralize the bank, but you've never been on the bank side trying to sell collateral. When banks put their name on things, prices start going down pretty quick. especially things like restaurants and bars. How much do you think used plates and dishes and glasses are you're going to get for that stuff? So, pretty tough. So if I'm into this third where liquidation of the collateral is my only source of repayment, then that loan is usually in trouble. Okay, certain types of collateral is better than others. Obviously, right now, real estate is pretty hot, but I've been in times where we tried to sell real estate at a bank at 50 cents on the dollar and couldn't get it. So that's cash flow. The second C is collateral, what's securing the loan. And again, that often dictates what your use of proceeds is, and the type of collateral dictates the type of loan you get. So if what you're using the proceeds is for working capital and it's short term, and your collateral is accounts receivable and inventory, then normally you're going to get short term financing. Okay. If it's for equipment and things that have a longer life, then you're going to probably get maybe 5 or 7 year financing. And if it's real estate, you'll get longer term financing. So the use of proceeds and that collateral is dictates kind of the types of loans that you might qualify for. Then we've got character of the borrower, okay? And a lot of banks will combine that with credit history, because the way they determine character is to actually pull your credit report and do a background check, okay? Then we've got capacity. So does the company have the capacity to take this debt on? Is its balance sheet strong enough? Do they have enough equity to absorb additional debt that you're requesting? And then the last C is the conditions, which could mean economic conditions, what's going on in your industry or the economy, as well as the financial condition of your firm. So out of these 6 C's, which one do you think is the most important to a bank? What do you think is the most important C?
Cash flow.
Cash flow. Okay, that's a good one.
Character.
Anyone else? Huh?
The character of the borrower.
Very good. So we're going to start with character of the borrower, because if you're not a good character, if you're a crook, okay, you're not you're a problem borrower. In the past, bankers say you have been hard to deal with. You've had defaults in the past. Your credit report's terrible. You had liens filed, you filed bankruptcy, things like that. Then there's no reason for me to do this other work. Okay. If you don't have good character, then the bank doesn't want a relationship with someone that's not of good character. So that's probably the most important. Your character is actually your biggest asset. We'll back someone if we know they'll do whatever it takes to get us paid. And we've dealt with some things where we've had to, during COVID, make a lot of loan modifications and delay payments, or even not have payments at all for some period of time. As long as we have a borrower that's cooperating, then a bank doesn't want to foreclose and sell off collateral and declare the loan in default. We would just want willing borrowers that, and banks don't like surprises. I'll tell you that now. So it's better off hearing it from you than from someone else. Okay. And so, if they think you're trying, it's just that, man, something's come up and we need to work through this, because at that point, if they've lent you money, they've kind of become a partner and they need to kind of work through those problems with you. But if every time I call you try to avoid me and things like that, then the only way to get to talk to you may be to file suit and get you in the courthouse is the only way I can talk to you. So yeah, character of the borrower and that credit history is the starting point. Cash flow would be second, okay? Collateral and capacity and conditions kind of are right but close behind that. You could be strong in all but 1 or 2 of these C's, and it's still, you could have great character. The cash flow of the business isn't too bad, but man, the collateral is really specialty nature. If we had to take this back, we could never sell it. And we get those kind of things sometimes from people want to build a unique building like iFly or something like that, where the ceilings are 35, 40 feet tall. If you have to foreclose on that, what are you going to do with this building? because it's such a specialty nature. So maybe the collateral is a little short of what the bank would like to have, or maybe the capacity, your debt to equity ratio is already pretty high, maybe $3 of debt for every dollar of equity, and you want to borrow more. So the bank says, you know, man, that's pretty high debt levels for us and things. So everything else looks good, but really we're not sure if you can afford to service additional debt at this time. And it could be conditions that, boy, this whole industry is having issues. Usually, like through COVID, it was hospitality, restaurants, and bars. Obviously they were hit very hard. So if you came in and said, I'd like a restaurant or a hotel loan during COVID, it was probably harder to get than it was pre-COVID, just because that industry was hit very hard. So let me go into each one of these kind of a little more detail. So primary source of repayment usually is your operating cash flow generated by the business to cover both the existing and proposed debt service. So the debt you already have plus any new debt you're proposing. So they usually are going to look at some kind of debt coverage ratio. So they may calculate your EBITDA, earnings before interest, depreciation, amortization, and taxes, and then divide that by the principal and interest payments on your debt. And they're going to want to see some cushion, not just 1-to-1 here. If you stub your toe and EBITDA falls, they're going to want to see some cushion. So they may say that they'd like that debt coverage ratio to be 120, 125% of your debt payments. The higher, the better. Okay, but they may have a minimum coverage they'd like to see. Then you've got secondary sources of repayment, like I said, and that would be personal assets of the guarantor. And remember, in Texas, I can't get your homestead and I can't get your retirement accounts. So those are excluded. Okay, but are there other personal assets you have, or do you have other cash flow from other wages, investment income, things like that? And I will tell you, that's not always that easy. We get a lot of people that are real estate developers and things, and their cash flow is real lumpy. They could have made $10 million cash flow 2 years ago and none last year. And so banks will look at that and kind of average thing and say, what's their capital gains over the last 2 to 3 years, trying to smooth some of that out. But they're looking to see if there's some other ways, if the business can't repay this, that they can still get repaid. And then the last thing is liquidation of the collateral. Okay, most of the time, I said the banks require personal guarantee, anything over 20% ownership. Most of the time it will be joint and several, meaning that you are guaranteeing 100%. And by the way, they don't care if you're 50-50 partners with someone else. The bank's going to sue whoever's got the deepest pockets, and then you can sue your partner. But they're coming after because each one of you is guaranteeing 100% of the debt. There are limited guarantees, but usually that's bigger loans and a long relationship with a bank to where they'll let you guarantee less than 100% of the loan. And then for the very best borrowers, there may be non-recourse financing, which means they don't guarantee the loan at all. But even then, the bank may say, but you need to put 50% equity in the deal for us to give you no recourse or something like that. It could have other. And then they're going to look at the guarantor's liquidity. So we get a lot of people have a big statement, a financial statement that says they're worth $100 million and they've got $500 in the bank. You're worth $100 million and only have 500 liquid assets, then you couldn't sell all of your other assets and turn those into cash quickly at full market value. So they'd say, well, that guarantor has lack of liquidity. Okay, exempt assets, like I said, trusts, retirement accounts, homestead, and then your personal cash flow and any contingent liabilities. And we have some people that have guaranteed a lot of debt outside of the bank they're requesting this loan. And they're going to want to know how many other things you've guaranteed, that how many people could come after you if you don't perform. So one of the ways to get character bar is to pull your credit report and see how you've handled credit in the past. The three big credit bureaus are TransUnion, Equifax, Experian. And then company-wide is Dun & Bradstreet. These are all credit bureaus that report your history, both business and personal. So credit score, FICO scores range from 300 to 850. Good is usually 630 to 739. Excellent above 740. If you're less than 600, some banks will say in their loan policy, we just won't lend to anyone that has a credit score of less than 600. So it's an audit, especially for smaller loans, especially the big banks. So the big banks have automated things for small loans. And so they may say for loans of 100,000 or less, if the borrower doesn't have a credit score of at least 630, then just tell them no. Okay, and so it's a yes or no based on that one number. There are a lot of things that affect your credit score. You know, tax liens, past due payroll, sales or property taxes, bankruptcy, charge off of other accounts, slow payments, excessive inquiries, all of those things lead to poor credit score, and that can lead to loan rejections. So your credit history really is your most valuable asset. It not only affects yes or no, but it affects interest rate as well. More people compete for people with great credit scores. For small loans, to lower the cost of underwriting, like I said, you may see them just run a credit history and make the decision based on that one number. Okay, banks will do a background check. They'll check with your customers, suppliers, competitors, and even other banks to assess your character. Part of that is the willingness for you to perform on your obligations. So your past borrowing history, honesty, attitude, cooperativeness. You know, Shasi will tell you that bankers hate when their exceptions come up because you haven't given them recent financial statements or your insurance or your property taxes hadn't been paid. She gets called on the rug in front of executive management because that's a exception to the loan and creates a problem. And so how well is this person willing to, when you ask for something, give it to the bank? And then obviously your work ethic, knowledge of the business, things like that. Okay, your collateral security for the loan. If you default, then the collateral can be sold to repay the loan. Okay, the banks will file a UCC security interest in placing a lien on the assets. And many times it's a blanket lien, meaning that they will cross collateralize and cross default all of your assets. So in other words, that you may have a line of credit secured with receivables and inventory and a mortgage secured by the real estate, but those two loans are cross defaulted and cross collateralized. So if you default on one, you default on both. And so both of those assets, both receivables and the real estate, are at risk. Banks will generally discount the appraised cost or market value of your asset. So it's not uncommon for them to look at real estate. You bring in an appraisal, say it's worth $1 million. The bank's going to see that as about 700 to 800,000, not $1 million. Because by the time they pay commissions, there could be property taxes, they have to carry insurance, things like that. They're not going to get 100 cents on the dollar. So they're going to discount that appraisal or cost or something to 20% discount or so. Accounts receivable, usually they'll lend 70 to 80% of receivables that are less than 60 days old. Okay, once it gets past 60 days, I can't tell if it's a bad debt or not. So I'm going to start excluding that of what I'm willing to finance as it gets older. But if I had to go out and actually collect from all your customers because you went out of business, I'd be lucky to get 70 cents on the dollar. Inventory, probably 40 to 50% at cost, because I'm not selling this one by one. I'm selling it in bulk. And in bulk, I'm going to take a discount because they know the bank doesn't have a use for that inventory. So they may lend 40, 50% of your inventory. Maybe 50 to 80% of your furniture, fixtures, and equipment, depending on what type it is. If it's, construction equipment, caterpillars and things, maybe at the upper end of that. If it's specialty equipment and furniture and computers, probably towards the 50%. And then special use assets could be discounted more heavily. And then if you've got personal assets like stocks, bonds, cash, things like that, then even then they discount stocks and bonds. They're not going to lend you 100 cents on the dollar because of the volatility of those assets. So I want to, again, stress, especially to the contractors out there, that contracts, purchase orders, and backlogs are not assets. I can't get a lien on those. Okay. Receivables, which are progress payments based on a percentage of completion, also can present a problem to a bank, because if you don't complete the contract, then that owner is probably not going to pay your receivable. And then the other problem is a lot of construction contracts are bonded, and a bonding company is one of the few people that can get in front of a bank in terms of lien. So these can be problematic for the bank if there are progress payments and bonding. It's a lot easier for those of you who are merchants who sell something. I've delivered it. Now there's an invoice, and now that owner is going to pay me. It's a completed transaction. That's much easier to finance than construction contracts that the payments are going to be spread out over a year or two as you do the contract. So don't be surprised if the bank wants to see your job cost reports and see where you are in terms of billings in excess of and cost in excess, to see whether or not you're over or under on a contract, if you're underwater or not. I don't want to wait until the contract's bad in order to take action. So this capacity is the balance sheet's ability to accept the level of proposed debt. So it's the amount of debt relative to equity that you have in the business. They may also look at the level of debt to your operating cash flow, this EBITDA. Okay, remember there's two ways to go broke in a bank: make bad loans and make no loans. Okay, bad loans, you go broke faster. Okay, so banks want to lend money. I just don't want to lend money to the people that can't repay me. Okay. And so the higher your debt ratio, the more financial risk the company's taking on, and thus, okay, the riskier it is for the bank. So if you had a debt to equity ratio of 1-to-1, so you put in 100,000, the bank put in 100, then you're pretty even. You both have as much to lose and as much at risk. Once the bank has 200,000 in debt and you only have 100 in equity, then the bank's putting up a lot more of the money, 2/3, and you're only putting in 1/3. So if something happens, then if I have to sell the assets, if I sell them for less than 1/3 of what we thought they were worth, then I'm going to lose money. When it becomes 3-to-1, obviously you're becoming pretty overly leveraged, and the bank may have some concerns, but it's really relative to other firms in your industry. Some industries can use more debt than others, so they will benchmark you. But basically at 4-to-1, where you got 80% debt, 20% of equity, and you want to borrow more money, that's going to usually make most bankers kind of twitch and say that seems like an awful lot of debt. Okay, conditions can refer to the financial condition of the firm as well as economic conditions and industry conditions. Banks use something called Risk Management Associates, RMA. This is a company that gets information from banks, sorts them by industry and size, and then publishes a book. You can actually go down, I think it's in the Austin Library, I know it's at UT Library, and just Xerox a page out of that book. Or if you go to your banker, a lot of times they can give you a copy of that, but they'll break it down by industry. So here's what some of the financial ratios are for people that are retailers, or people that are in service companies, or people in construction. And so that's how they kind of benchmark against similar firms of similar size. And then outlook for the national regional economy, interest rate forecast are also considered, how sensitive the business is to economic declines. So if the bank thought that the Austin construction market was getting overheated and they were going to start tightening lending in this area, okay, then loans to general contractors and subcontractors may be more difficult to obtain. If restaurants, bars, and hospitality have high failure rates, then lending in these industries may become more difficult. So obviously, it still is relationship driven, but if you don't have a relationship, going when that industry is out of favor because of some economic conditions affecting those industries, it can make borrowing more difficult. So here's how banks make decisions. Some banks have two signature approval process. So in other words, your loan officer is basically your sales representative pitching your business. And then there's a credit officer who is not incented by making loans. They are the deal killers. Okay, they're the ones that are going to say, here's why we shouldn't make this loan, because they're responsible for the credit underwriting. So this is a two signature sign off up to maybe some level of amount of loans that they can sign off. Others will have a loan committee depending on the size of the loan. So at our bank, we have both an executive loan committee and a director's loan committee, depending on the size of the loan. And those people discuss and then vote on your loan. You are, allowed, if you get turned down, you are allowed to ask why. Because you don't want to go to 10 more banks and get turned down, because most banks underwrite the same way. So if you've got a problem in one of these C's, you need to correct that before you go and talk to other banks. So you need to find out why. Now, it's real easy sometimes for the loan officer to say, well, I really pitched hard for you, but they just didn't like your loan and the committee said no. That way they don't burn any bridges, and so they can still have a relationship with you. But you need to say, well, can you tell me exactly why, what they didn't like? And this is usually what you'll see why loans are rejected. You have no credit history or bad credit history. Okay, most of the times those don't even make it to committee. I mean, they're rejected before they even get past the loan officer and the credit analyst. Okay, no track record to show historical debt repayment. Okay, insufficient collateral, poor financial record keeping. I can tell you, if you show me financials and the balance sheet doesn't balance, okay, or what you're showing on profit on your P&L doesn't tie to what is on the balance sheet, those kind of things. And remember, most of you are not accountants. You're trying to save money and you buy QuickBooks and try to do accounting. That is not the best use of your time. Okay. Pay an accountant, get good numbers, because you already have influenced that banker and things when they see financial statements that just aren't good record keeping. I can't depend on the numbers to make a decision. Too much leverage already, so you already have too much debt. A negative net worth, where you have more liabilities than assets. So technically, if we liquidate right now, your assets couldn't pay off all the debt you've got now. Okay, so in those cases, they may say you need more equity, not more debt. You're asking the wrong kind of capital. Okay, and of course, the worst thing that can happen is for you to have to be turned down for all other sources, then have to go talk to someone that knows you have to have their money or else. To make payroll on Friday, they've got the upper hand. So just be careful. You don't want to put yourself back into a corner because the money can get really expensive from some pretty shady people. No secondary sources of repayment, especially nature of collateral. Asking for too long a maturity. So you want 20 years on accounts receivable inventory, or 20 years on equipment that only has a life of 5 or 7 years. Or really unusual repayment terms of some kind. All of those might be a reason why a bank may turn a loan down. Okay, you do want to ask why if it's turned down, but sometimes it can be a problem with the bank. So for example, a bank may turn something down because they're too concentrated in that type of loan. Or the bank just had a bad experience in that industry. I can tell you, if Shasi just liquidated a restaurant, and you came in with a restaurant loan and she's had a bad experience selling off dishes and glasses, what do you think? That's human nature to say, no, I don't think I want to do another restaurant. Not right now. So sometimes it's not you, it could be the bank, or that your loan is outside their market area and hard to service. Okay, so banks like lending in their backyard, things they can go see. Okay, it's not a relationship, it's just a deal. So remember, banks want to know that they're going to have a relationship, deposits, merchant accounts, loans, okay, future loans, things like that, that this isn't a one-off deal and you're banking with 20 other banks. Okay, then, they don't need the loan that bad just to book a loan for no reason if there's not a relationship. And then the size of the loan, it can be too small, so it's not profitable for the bank, or too big because you've hit their legal lending limit. Every bank has, based on their capital, has a maximum amount that they can lend. Okay, so a really small bank may have they can't lend over, $3, $4, $5 million. Now they can go and find other banks to participate and sell the loan and things like that, but really small banks may have really small legal lending limits. So the types of bank loans, then we said lines of credit, working capital, a borrowing base. Usually the bank will lend you 75 to 80% of your current receivables, 40 to 50% of inventory, usually a 1-year maturity, usually at prime plus 1 to 3%, pay interest only, principal at maturity, as long as you're in compliance with your borrowing base. A term loan is usually 3 to 5, maybe 7 years, maybe at prime plus 1 to 3 to finance equipment, autos, things like that. Many perms and mortgages, 10 to 25-year amortizations, may balloon in 5 to 10 years, usually financing real estate. Owner occupied real estate's easier to finance than investment, but and then there are SBA guaranteed loans and 504 loans that I'm going to let Shasi address. And then the other things with bank loans, remember, is that there are personal guarantees, even with SBA loans. Shasi will talk about that as well. You can have prepayment penalties. You can have minimum and maximum financial ratios in your loan covenants. You may have a borrowing base to monitor your collateral, and they may even lockbox you, meaning that you have to tell the customers to send their payments to the bank's PO box, and then the bank then pays down the loan as those receivables are received. And then, of course, you always have fees. Most of the time, you're going to get floating interest rates. You may have a cap or a floor. You can ask for a fixed rate. Right now, rates have been so low, most borrowers think probably interest rates may rise over the next couple of years. So we're seeing a lot more people wanting caps and floors on their interest rates. But there are also fees that can be charged, as well as loan documentation, attorney fees, and other things like that, including when you get into real estate, environmental, site assessments, deeds of trust, legal, and other things like that. I'm going to skip over this. This just goes more into a revolver, but basically the bank can approve you to some predetermined limit or amount, subject to this every month you turning in showing what 70 to 80% of your current receivables and your inventory is, to show that you've got more collateral than you've borrowed. If the borrowing base comes in lower than you borrowed, then you need to pay it back down to get back into compliance. Okay, so then you can, if you for some reason went to several banks, they couldn't make the loan to you for whatever reason, that your balance sheet just wasn't strong enough or the cash flow wasn't there, then you can move to non-bank lenders, asset-based lenders, factors, finance companies. Okay, usually these are at higher interest rates. Okay, so they do lines of credit as well, but instead of prime plus 1 or 2, you're going to get maybe interest rates upwards of 8-10%. Factoring, where you sell your accounts receivable, so they may advance 95% of your accounts receivable. They'll buy it for 95 cents on the dollar, and that may sound cheap, except you were going to get paid in 60 days. So when you annualize 60 days into a year, that's 6 60-day periods. So 5%, 6 times a year is the 30% that you're paying for that money. So a lot of companies just don't have the margins to be able to factor. But fast growth technology companies, they're willing to pay that kind of thing because they don't have to give up ownership. and they can generate, by getting the money, they can grow the company by selling their receivables and pay that high rate. Purchase order financing, like I said, usually it's a low advance rate. The other thing that's hard to finance, any of you in healthcare, it's hard to finance medical receivables, Medicare, insurance companies, things like that, because the government can come in and just say, we think you overcharged, and therefore we're going to offset your receivables. And now all of a sudden the bank doesn't have any collateral. So floor planning is inventory financing. A lot of times this is done by the manufacturer. So GMAC might finance the GM dealer, things like that. But floor planning is a type of inventory financing. Equipment financing, usually, and a leasing. Basically, these are asset-based lenders. A bank, okay, wants to get, are called cash flow lenders. They want to get paid. They only take collateral as a last resort. Asset-based lenders, if they have to take back a piece of equipment, they actually are used to dealing with used equipment and selling the secondary market to other users. And therefore, they may lend you a higher percent of that equipment than a bank would, but usually at a higher interest rate. But they may advance more than what a bank would. Like I said, there's private debt out there. Usually, like there's a company here in town, that they may have 8 to 18% interest rates. They may take a profit participation or equity in your company. One of the companies, Escalate Capital here, their minimum is $10 million in revenue. There's another one, Alliance Bernstein, I think theirs is 20 million. So some of these hard money lenders in private debt have pretty high thresholds to borrow. And then you've got these specialty online platforms, fintech company like Prosper and Lending Cub. These are peer-to-peer lending. Just do your homework. There are a lot of shady operations out here, so just make sure you do your due diligence. And for construction companies, this Build, Funding Circle, and Fundera all tout that they will do purchase order financing, they will do construction lending, they'll do small business loans. And then you've got the nonprofits and community-based organizations like People Fund and BIG, okay, microloan and community advantage loans. Okay, and so this is the equity side. Like I said, I'm not going to spend much time here, but basically it's your own capital, friends and family. Usually you have common stock. If you are a corporation, you own the common stock. When you bring in outside investors like angels, many times they'll come in with convertible debt or they'll take preferred stock. Okay, so they are mezzanine. They are between the senior lenders, the bank, and you as a common stockholders. They come in here in the mezzanine in that middle position. Okay, there are angel networks like Angel List and CTAN. A lot of times they may do subordinated convertible debt converted to stock at a future point at a discount or a valuation cap. Then you've got institutional venture capitalists looking for high-tech growth companies that can scale, give them 5 to 10 times their investment back. Okay, they may invest 100 to 500,000 in pre-seed, $1 million to $2 million in seed, 3 to 5 million in Series A. And for that Series A, they may take 20 to 25% of your company. Okay, 10 to 30 million for Series B, they may take another 10 to 20%, plus they want you to have an option pool for key employees. So by the time most tech companies go through seed, Series A, Series B, the owners, the founders end up owning somewhere between 5 and 10% of the company. Okay, and the investors own the rest. So if you don't like that and want, the reason you wanted to run your business is I didn't want partners telling me what to do, then don't go raise venture capital. They sit on your board, usually have control. There's all kinds of conditions to their money, so don't go to venture capitalists. Private equity is usually growth capital. They're looking for companies, profitable companies, and things that they can buy anywhere, usually controlling interest 51 to 80% of your company. have the owners or succession management roll over the other 20%. And then when they get 5 years down the road, sell the whole company. So the owners will get a second bite of the apple on their 20% down the road. Okay, so VC and PE firms usually aren't appropriate for most small companies because you just can't scale and have the kind of margins. Okay, they love to invest in enterprise software companies who have 80% gross margins, 25% operating margins that are growing at 30 and 40% a year. That's the kind of companies they're looking for. Okay, so that's kind of summary of debt sources, non-bank lenders, and then equity sources. So now I'm going to turn it over to Shasi and let her talk to you about the SBA, because for many small businesses, you know, it's a lot of people say, I don't want to deal with the headaches of getting an SBA loan. There is some there is some paperwork on the front end, but once the loan's made, you rarely know that the SBA or the government's even involved. But they can give you longer maturities than a bank normally would go. You can get some, interest rates, as she'll talk about on the 504, that are very advantageous. So there's lots of programs like that actually would be the best form of capital for a lot of small businesses, especially those looking for longer term financing. So Shasi, why don't you lead us off and talk about how the SBA works?
Okay, sounds good. Thanks, Jim. And yes, Jim is right. Most people are like, oh my gosh, an SBA loan. It sounds terrifying and like lots of a bureaucratic nightmare. But there are a lot of lenders like me who specialize in SBA lending. And basically we're here to help you through that. There are a lot of rules, a lot of nuances because their policy manual is 590 pages long, but that's why you really want to connect with an experienced SBA lender and who can help you through all of that. And the SBA in general doesn't lend money directly, although, some of you may be aware of the EIDL program that has been used quite a lot recently for the economic injury disaster loans related to COVID. There has been some direct SBA financing available with that, but that's very specific to a specific economic disaster, which we've had with COVID for many people. But other than that, you do need to work with a lender, and on the 7A loans and on the 504 loans, you're working with a lender and a CDC, which is an entity that helps facilitate the whole bond portion of that. And I'll get into the bond portion of 504 loans in a minute. But anyway, like I said, you probably want to work with someone who is experienced because there just are a lot of rules and regulations. And there are preferred lenders. American Bank of Commerce is a preferred lender, but many lenders are preferred lenders. And basically that means that they have the experience and have made enough loans that they can make a loan without going through the SBA directly for credit underwriting approval. We still have to follow all the same rules and regulations, but we actually make the decision as to the credit, whether we approve the credit. So you probably want to find a preferred lender to work with. There are other lenders who do SBA, but if they're not preferred, they're probably not doing a whole lot of SBA loans and maybe aren't as familiar with all the rules.
And Shasi, preferred lenders speed up the process, right? I mean, because of that.
Oh, absolutely. Absolutely. If you're not a preferred lender, the whole package has to be actually sent to the SBA for them to do the credit approval process. And so that's just, the bank is going to do their own credit approval process. And then if they're not a preferred lender, then on top of that time frame, after they've approved it, they need to send it to the SBA for SBA approval. And that can be another 2 to 3 weeks. It could be 6 months. It kind of depends on how busy the SBA is. And of course, they've been really busy lately with all of the COVID programs. So next slide, Jim. Okay, so I'm going to run through this actually fairly quickly since I know we're getting close to to our time, and we want to leave time for questions. But there are three major programs. There's the 7A and Express, which are kind of like part of the 7A program, and the 504 loans. Cap lines are actually a part of the 7A loan program as well. Let me talk real quickly about the Express loans because they only have a 50% guarantee. So those are typically what, as a lender, I'm not looking to do because I just assume put you in something else where we get more of a guarantee. And to back up on that a little bit in terms of like, what does an SBA guarantee mean? That's the SBA guaranteeing, providing a guarantee to the bank of the loan. When we talk about percentages that they're guaranteeing, that the SBA on an Express loan is only guaranteeing 50%, where in the regular 7A program, they're guaranteeing 75 to 85%. So as the banker, I'd much rather have that. Now, just because, one caveat, just because the SBA is guaranteeing, that doesn't mean that that's in lieu of your personal guarantee. You are definitely still personally required to guarantee the loan if you're a 20% or more owner of a borrower. So just to make sure that you understand that you're still on the hook, even if SBA, pays us on the guarantee eventually, and hopefully we hope to never get to that point. We hope that everybody pays their loans and we don't have to call on our guarantee. But if they do, you're still on the hook, and then you're on the hook to the government. So just to make sure that that's clear. But the only way you might want to request your lender really focus on an Express loan for you is if you're a veteran. At least in this next year, it's a 0% guarantee fee for a veteran. So that on the Express program. So that might be a reason you might say, well, I really want to do the Express because I don't have to pay a fee. So that's the Express loans. And then the 7A loans, like I said, they provide us a 75 to 85% guarantee. If it's a loan up to 150,000, it's an 85% guarantee. And over that, it's 75%. So the rates are subject to a maximum rate allowed by the SBA program and kind of depends on the loan amount. But basically anything above 50,000, it also depends on the term, and the max rate is 2.25% up to 7 years, and 7 years and beyond, the max rate is 2.75%. Excuse me, that's the spread. 2.25% over the prime rate, and then 2.75% over the prime rate for a term loan that's over 7 years. So basically the use of proceeds is everything that you can imagine you might need financing for in terms of purchasing machinery, equipment, working capital, etc. I think for a lot of you, I'm guessing based on the industries that you're in, it's very possible that you're probably not capital equipment intensive heavy, and more leaning towards needing lines of credit. And so for that, I'm going to go up to the top, which is the cap line, and that is a line of credit program that's allowed under the 7A program. Going back, we can do lines of credit under Express as well, but again, that's only the 50% guarantee. Now, with the cap line, it does require that we use a borrowing base, and Jim already talked about that. And generally, we're advancing only like 70% of accounts receivable and 40 to 50% of inventory. And there are
I see we lost you, lost the sound.
Do you have an email address, Jim?
Yeah.
Shasi, I'm sorry to interrupt you, but we've lost your sound and she can't hear us either. Okay, I've sent her a message. Jim, if you could maybe stop sharing your PowerPoint to get her attention, that might help us.
Okay.
And then we'll see if we can get her. She's not seeing us.
Shasi?
We don't have a cell phone for her.
Yeah, why don't you just go ahead and
Let me see.
put a PowerPoint up and say we can't hear you?
There we go.
I just sent her a chat, but she didn't see that either. So
For chat.
let me let me see if I've got her phone here.
I'm gonna hold up my sign in case she sees it as well. But we'll see. I don't think she's looking at the screen.
She put her glasses on.
I think she knows now.
Okay.
Yeah.
Okay.
Something when she turned.
Hey, I'm so sorry.
Got it.
Can you hear me now?
Yes. Yes.
Well, okay. So I don't know at what point I lost you.
You were just finishing up Capline.
Oh, okay. So I went to the 504 loans. And so did you hear any of the 504 loan portion?
No, none of the 504, but on Caplines, real quick, talk to them about lines of credit under Cap loan for, especially for some of the contractors and builders here. Because they have a builder's program, a contract loan program.
Okay. Yeah. Okay. So I lost you earlier then because I did go over that. Oh, all right. So yeah, there's the working capital lines and there's contract. Did you hear what I said about contract financing? Okay. So that one I have to admit I've actually never done because I think of the difficulties that you talked about, Jim, in terms of, performance on contracts, although it'd be something I'd be happy to take a look at if somebody has a need for that and we can kind of delve into that, at another time. But the builders, I actually have done the builders cap line, and that is for the small general contractors to construct or rehab residential or
Oh, we lost sound again. Shasi, I don't know if you can hear us, but we've lost your sound.
Can you hear me now?
Yes.
I am sorry. I don't know why it keeps doing this. What I was saying is that the builder's cap line is for small general contractors to construct or rehab residential or commercial properties for resale. And so that's a real advantageous program. And I have actually used that before. Still hear me?
Yes.
Okay. Okay, good. Okay. So, we'll jump now to 504 loans, and those are basically used to purchase real estate and major pieces of equipment or equipment along with some real estate that your business is going to occupy. It's for owner occupied real estate, but it's a very advantageous program right now. I mean, it's always advantageous in terms of the equity injection that's required, which is only 10% in general, and then an extra 5% required for a new business, which is less than 2 years in operation, extra 5% for something that's considered a special use property. But if it's, plain vanilla warehouse, office space, et cetera, and you've been in business, you're only required to inject 10% equity, which is a lot less than a typical conventional loan. But other than the equity injection, right now the interest rates are really attractive on the bond portion. For a 504 loan, the bank finances 50% on a first lien, and that's 50% of the total project cost, and that will be at whatever negotiated rate they have between you and the bank. But the other 40% portion, which the bank temporarily finances, but then it gets rolled into bonds, and those bonds right now are running just above 3% fixed for 25 years. And so that's what's really particularly attractive about 504s right now. So now those rates change monthly.
Frozen now, Shasi. Yeah, she's frozen, I think. Not even sound. I think it's video too.
It might be a connection issue.
Yeah.
What we might be able to do
Yeah.
if she comes back, perhaps what we could do, Professor Nolen, is
Let me finish up, and then we'll
Okay.
get her to follow back up. It's just
Okay.
and then we'll open it up for questions.
Perfect.
Okay. But this 504 loan program, like she said, the bank makes two loans, 50 and 40%. CDC approves you once the interim construction is done, the bonds are issued and pays off that 40% to the bank. So for the bank, while there's no guarantee on these loans, the bank basically is getting 50% loan to value. By putting up half the money, they get the lien. So Shashi's back on now. Shashi, can you talk?
Yeah, I'm here. Can you hear me?
Okay. Yeah.
Okay.
Yeah. So we were finishing up 504. So
Right. Just finishing up 504. That's mainly what I was that's all really I was saying, wanted to leave time for questions because I know we're at the end of our time.
yeah, and so we won't read off all of this on this, but your loan documentation that you need to bring to the bank, it will vary, but for the SBA versus the SBA has specific forms that need to be filled out regarding your personal history and things like that. But basically the data they're looking for is about the same as what banks usually are looking for. And that's going to be historical financials on you and the company, tax returns on you and the company, things like that.
It is. It's all really the same from an underwriting perspective, and really they've simplified it actually quite a bit. So there's really just a couple of specific forms. So it's not that bad from a filling out forms perspective.
And most banks that are pretty active, SBA lenders, preferred lenders, usually may have someone in-house that helps you prepare the loan package and things like that. Preparers. Right?
Oh, absolutely.
Yeah. All right. So these were the last things, some slides in here, some kind of helpful hints that, talk to other small businesses, get a referral on a bank and a loan officer that they like to deal with. Go to the main branch, not to some little, 2-person office in the suburbs. That's not where the decisions are made. So usually you want to go downtown. Banks are relationship lenders. They don't want to just do a deal. So form those relationships even before you ask for a loan. It's okay to go and take a banker out to lunch, give them your financials, let them know how your company's doing, things like that. Banks usually want your entire relationship, personal, business, everything over there. I can just tell you, if I were not talking as the banker, talking as your small business consultant type thing is that you always want to have banks compete for your business to get the best deal. You always want to have a secondary bank because if you get crossways or your banker leaves or something, that you've got someone else know something about your business. Okay. And then even within a bank, you'd like to have a couple loan officers that know about your business. So if one leaves, you're not stranded trying to educate some new person about your business. Banks don't like surprises. Again, you want to be transparent. And if you have a problem, go and, the easiest thing, if the reason you're not paying is because you can't, that's different than if you don't want to. And if you can't, then say why you can't and then work it out between the two of you. Other things, getting certified as a woman or minority or hub business can help you level the playing field and get government commercial contracts. Okay, it's a great way to kind of get started in things, but just be careful because they can provide you steady work. There may not be as cyclical, the government and these big things as other commercial contracts, but be careful because sometimes these are larger contracts and those customers have more negotiating power on profit and when they pay and things like that. If you go to sell your business, being labeled women, minority, hub may lower the pool of potential buyers if the buyer doesn't meet those specifications. So you always kind of worry that, as you get, so it's great to get started, but eventually you want to kind of grow your business and things, trying to do what you're based on your previous business and referrals and things like that, so that if you don't get labeled, if 70% of your contracts you get because you were a hub and the buyer isn't a hub, then obviously that has an effect on value. And a lot of times large customers of government require bonding or have other things in there that make financing more difficult. The greatest issues right now for most of you contractors, supply chain disruptions and finding skilled construction workers and subcontractors. This can lead to delays. If the contract has liquidating damages, there are contractors that have gone broke in the middle of a great construction economy because they gave fixed price contracts and they can't control the cost of commodities and labor and other things like that. Remember that your people and your subcontractors are your greatest assets and probably your biggest expense. So they are customer facing. They are your company's field representative. So, make sure that, you're getting the right people in the right places. Construction's a low margin business model, high volume, low barriers to entry, very competitive. One bad contract can wipe out all the profits from all your good contracts. So bidding and estimating are important. Have good job cost records so you can jump on problems quickly. Do post-mortem review of your jobs, see what went right, what went wrong, so you can correct and don't repeat problems. Again, you probably shouldn't be doing your accountant. I always say hire a good attorney and a good CPA. If they're doing their work right, they should more than pay for themselves. Try to develop a special skill, niche, or differentiate you from other contractors, give you a competitive advantage. And finally, think about forming maybe an advisory group or a board or others that can act as a sounding board and give you some outside perspective and advice. And that could be people in this organization, you guys taking these classes in different industries and things. And if you say, look, I'm having trouble attracting and retaining key employees, and someone else can say, well, I tried this and that seemed to be pretty successful, and someone else can add their 2 cents. And if you're not direct competitors, you can kind of serve as kind of advisors to each other. And then a lot of times you can also, if you think you need accountants or lawyers or other people like that, if you find someone that really just wants to kind of be a mentor thing, it's usually not about the money, it's more about their time. But really finding someone that just has taken an interest in you and your business and helping you along. So that's all I have. Let's open it up for questions about financing. Anything you want to ask Shasi or I about me about financing, contracting any of that type of. So any
I
questions?
have a few in the chat already, so
All
I'm
right.
going to go ahead and fire those off on behalf of the folks that posted them. And then if anybody else would like to ask a question, please put your name on the chat and we will call on you as orderly as possible. So thanks, everybody.
Yeah, so Shasi Lee Wang wrote that when you sell, if you're going to sell your business a couple of years, should you avoid getting an SBA loan?
Well, I don't think necessarily that if you're going to sell within the term of the loan, it would require SBA approval for a change of ownership if that loan isn't going to be paid off by, say, by the business price. In other words, if you don't, and if you want that loan to sort of go with the business, then it would have to be reapproved by the SBA, by the lender and the SBA for a change of ownership. So it doesn't necessarily preclude you're getting an SBA loan right now, but you kind of need to think about the potential,
But the
consequences.
buyer may need to go get separate financing and pay off the SBA.
Yes, and that's another way to do it. Definitely is paying enough that pays off that loan. Yeah. So.
And most of the time, the SBA is going to require an appraisal on the business. And so, that you're not selling to your cousin at a high price and
right.
things like that. So there's appraisals and stuff in the business. If you get an appraisal, then finding another lender or going and getting the lender and SBA approval to assume that loan might be justified by that appraisal and things. So.
Right.
Right.
And Ms. Wang also had another question a bit earlier on, which is, now that it's the end of the year, I am behind on my bookkeeping. If I am to apply for a loan, up to which month my P&L needs to catch up to? So I think in other words, she's asking for some advice there.
Sure, preferably within 90 days. Yeah. So, I mean, or the most recent that you can get to. I mean, it'd be nice, like right now, it's November, it'd be nice to have a third quarter statement through September 30th.
Yeah, usually they're going to want the previous year end, and then they're going to want something within 90 days.
Right.
Yeah.
And then Shauna had a question. If you have an EIDL, does that work against you or for you to get another SBA loan?
I don't think it works either way. I mean, we definitely take that into account in our underwriting in terms of the debt service. I mean, even though I know that the debt service right now I think is postponed for 18 to 24 months in terms of actually making payments, we go ahead and calculate that into debt service of what that payment is going to be once those payments start. And so are including that in that debt service coverage ratio that Jim talked about earlier, calculating, your cash flow versus your debt service. So it kind of depends on whether you have enough cash flow to kind of layer in more debt that you're going to be able to cover all that present debt of the EIDL and future debt, proposed debt, new debt.
And by the way, the SBA, as you can see, most of this, they can guarantee up to $5 million at the bank. They at 75% guarantee, that's, 3.75 million or something like that. You could have multiple loans underneath that. So you could have $1 million line of credit and a $2 million term loan, 7A, and that would be a total of 3 that goes towards that 5 million, right?
No, that's correct. And if you have a 504, say you have your real estate also, it's only the 30 to 40% portion that rolls into the bonds that counts against that 5 to 5.5 million max that you can get.
All right, our next question is Ms. Wilson an SBA lender to connect with?
Oh, absolutely. Absolutely.
Yeah, and I will tell you is that if you go around and talk to different people, there are certain banks that are more active than other banks in doing SBA lending and things. But mainly what you want is, even before Shasi joined ABC, she was actually packaging loans for SBA in her private consulting. So there's probably not anyone that knows more about this program than Shasi does. So
Thank you, Jim.
All right, just want to continue to encourage anyone who'd like to, we would like to know if we can get your contact information, Ms. Wilson. That was a question in the chat, so please let us know how best to share that.
Absolutely. I'll get that to you, Emily.
Thank you. And want to continue to encourage anyone to come on camera and ask a question. We'll give it a few more pauses, awkward, strange pauses, until anybody asks a question, and then we'll hand it off to Dr. Jarrett to wrap up.
You know, I will tell you that, you know, you hear the term sometimes, growth killed the company. Okay. And I just remember, you're in a marathon. You shouldn't try to sprint because you won't finish the race. So it's about really controlling your growth and letting your balance sheet keep up with your profit and loss statement. So it's real easy to grow your profit and loss and get a bunch of contracts, but you don't have the, you know, asset base and the financing lined up to do that level of volume. And so just be careful about growing your company, you know, steadily and things. And so for most small businesses, it's okay to grow 10, 15% a year rather than trying to double your sales every year. That's what gets most small companies into trouble, is that they grow beyond their ability to finance that internally. And then they're forced to go out and raise external capital. And if they don't have access to that, so the longer you're in business, then obviously the more history and track record you have. You know, so when a bank says track record, that usually means 2 to 3 years. That does not mean 6 months. Okay, 6 months is not a track record. I mean, it's nice to be able to look at that, but you know, most banks would like to see how you manage in a good economy and a down economy. So the good thing about COVID is that it did stress test a lot of businesses and a lot of industries. So we found out how well people could actually adjust to those economic conditions. And so that's always good. If someone made it through that, then that gives you a little stronger feeling that this person, you know, a rising tide lifts all the boats. So it's easy for people to succeed when they're, you know, it's a great economy. When things aren't doing well and you manage through that, that tells the bank something about your management and your character. And so that's always important as well. And it is relationship. Remember, we have people on the board from all different industries and things. And, you know, someone will say, how did this loan come to us? Was it a referral? They just walk in through the door. Do we know these people? How do we know these people? What have they done in the past? So those are the kind of questions that get asked, you know, and you'd be surprised. I mean, you know, I had someone said, yeah, I saw that borrower getting out of his $300,000 Ferrari. So we know why he needs to borrow money, because he's spending money foolishly on big boy toys and things like that. You know, those kind of things give a signal. I mean, that, you know, what you like to see are hardworking people and things, and you want to help them as much as you can. But at the same time, we want people that are going to be prudent about how they, you know, we like borrowers that want to get the debt repaid. You know, that's important to them. I mean, when you get a borrower that says, you know, one time I had a borrower said, you know, if you're going to go down big. So you shouldn't go down for just a little bit. You might as well borrow 10 million, because that bankruptcy is the same at 10 million as 1 million. And when you get a borrower with that attitude, you know, most people aren't going to be very interested versus someone that has a healthy respect for wanting to get their debt taken care of. So the borrower matters and relationship.
We have 2 more questions, and then I think we'll hand off to Jorge or Dr. Jarrett to wrap up. So the last 2 questions. First, Shauna is asking, how does a line of credit show up on your debt?
Yeah, so if Shasi approved you for a $500,000 line of credit, if you didn't borrow anything, it wouldn't show up on your balance sheet at all. It'd be in the footnotes if you had footnotes in your financial statements saying that the bank had approved you for up to $500,000 in terms of the loan and thing. But until you actually have anything borrowed on the line, then it wouldn't show up as a liability. It would just be available to you. And if it's available, it doesn't show up on your balance sheet.
Thank you. And the final question, is SBA lenders the same as applying for a 7A or one of the others? And that's come from me, but it was actually through an email from Nikki Pessin. I'm asking.
Oh, okay. So not quite sure I understand the question, but basically, if you're thinking you're wanting a 7A loan, then yes, you're going to go through an SBA lender like me or another bank that does SBA loans. Does that answer your question, or was it something different?
I'm hoping, I don't know if Nikki's able to come on and say or confirm yes or no. Oh, she's gave it a thumbs up.
Oh, okay, good.
Yes, we have a thumbs up.
Right,
Okay.
right. Okay.
Great. All right. Well, Jorge, can I hand off to you?
Yes, well, let me first of all thank profusely Professor Nolen and Ms. Wilson. I hope you get a lot of people inquiring about how to get SBA loans. Sorry for the little glitch we had there. You have a comprehensive presentation. This undoubtedly will add to what we know as our resource guide, and will tremendously beef up our financial section. So thank you all so much for taking time to speak to us, and we will make this session available through videotape, and we will promote it. I think that this is a one-of-a-kind thing. You've been able to transition both from what's required in the private sector to, caveats regarding public contracting. Thank you all so much for doing that, and I mean it also for our class participants. I noticed that most of them have stuck around. So we've had a tremendous evening again, and we look forward to seeing you. Have a great Thanksgiving. Jim, I don't know if you want to say anything else. I guess not.
Yeah, no, I think he's gone. So appreciate everybody's participation in things. And again, let either Shasi or I know if you have any questions. We'll be glad to visit with you. So
Absolutely. Thank you for the opportunity to help present and participate. And I really look forward to hearing from some of the participants in the class, in the training.
Thank you again.
thank you, Corey. All right. See you, JB.
Thank you both so much.
All right, y'all be good.
All right.
Thank you, James.
Happy Thanksgiving.
Hi, Emily. Thanks for the help.
Thank you. Thank you all.
Thank you.
Thank you. Thank you very much.